Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, at least for today, the setup looks fairly positive, but whether or not we manage to hold on to any opening gains is something that we'll be watching out for. Of course, it was a forgettable week for the market last week. We saw the Nifty shedding somewhere around 3% or thereabouts. There were deeper cuts across the mid and small cap universe as well. Remember, we are off almost or over 8% from the top on the Nifty, and for the broad end of the markets, we are off almost 10% from highs. This morning, GIFT Nifty hinting at a mild start, but let's see where we open and whether or not we manage to sustain any kind of opening gains or not. ICICI Bank reported good set of numbers, so that is also expected to provide some cushion to the market after the kind of sell-off we saw last week. But of course, lots lined up over the next 30 to 35 minutes. Lots of earnings to watch out for, lots of earnings to digest. And of course, all your stock-related queries will also be in focus. If you have any queries, keep them coming in on a live feed. We'll try and take them up. But before we move any further, take a look at the top stories at this hour. Wall Street closes mixed on Friday with the Nasdaq hitting record highs while the Dow and S&P 500 ended with losses. Meanwhile, Asian markets trade largely higher with the Nikkei rising even as the Japanese ruling party loses parliamentary majority. The GIFT Nifty is suggesting a mildly higher start for the Indian market. Crude prices slumped with the Brent slipping over 4% to about $72 a barrel amid easing geopolitical tensions. Israel's retaliation against Iran on Saturday did not hit crucial oil facilities and disrupt energy supplies. And ICICI Bank's second quarter numbers beat estimates with best-in-class numbers. Asset quality improves, although net interest margin comes in at a 9-quarter low. Meanwhile, Indigo delivers its first loss in 2 years as higher fuel and maintenance costs take a toll. And in key earnings to track today, Sun, Pharma and Bharti Airtel from the Nifty will be reporting second quarter numbers. Also watch out for earnings from Ambuja Cements. Well, those were the top stories at this hour, but just quickly taking a recap as to what really happened last week and what are the cues looking like for today's session. We had a fourth straight week of fall on the last week. Of course, it's the longest weekly losing streak for the market for 2024. In fact, it was actually the longest losing streak since August of 2023, if I may say so. Sensex, Nifty Bank, all of them fell 3% last week. The mid-cap index plunged 6% last week. And the mid and small cap indices posted their biggest weekly loss since December of 2022. Except FMCG, all the indices posted losses last week. IndusInd Bank, Tata Consumer, Adani Enterprises, Hindalco, BPCL, these were some of the top laggards for last week. And of course, BSE listed companies erased over 20 lakh crores in market cap last week. So that was the kind of fall and bleeding that we saw across portfolios last week. On Friday as well, we saw, we pulled back from the lows of the day with the Nifty ending just about shy of that 24,200 mark. But for this week, 24,000 on the downside should be a key level to watch out for. And of course, Nifty Bank will also be in focus given the fact that we saw IndusInd Bank crashing nearly 20% after week set of numbers. However, ICICI Bank may provide the much needed cushion that the Nifty and the Nifty Bank index really need at this juncture. Put call ratio on the Nifty fell to 0.87 from 1 in the previous session. And if you look at the F&O ban list, Dixon Tech, which saw a near 10% kind of a crack on Friday. IDFC First, L&T Finance, these are some of the new entrants in the F&O ban list. And some of the stocks that will continue to remain in F&O ban are the likes of Rathi Industries, Bandhan Bank, which also reported numbers, by the way, Escorts, India Mart, Manappuram Finance, NMDC, RBL Bank. Out of F&O ban, IEX and Piramal Enterprises. FIIs remain net sellers to the tune of 3,000 crore rupees, but DII buying support is intact. But on that note, let's bring on board our guest for today. Joining me is Ajit Mishra, who's a Senior VP Research at Religare Broking. Ajit, great to have you on the show. Looking at the market, we came dangerously close to that 24,000 level on Friday. In fact, we were looking like we would break below that level at one point. Given the fact that we've come off significantly, from all-time highs, 8% or so, what is it that you'd be watching out for this week? Do you think, buy on dip will remain intact and we could see some bit of buying after last week's drubbing?
Yeah, good morning, Nandita. So yes, see, after 4 weeks of decline, especially like the last week, we saw the pressure, resuming. Earlier 2 weeks, we were more of like range bound move that we were seeing in the markets. It's kind of a, like we were anticipating that the in line with the earlier correction that was lasted for a week or two and more of a like time-wise correction. But this time around, it's a serious price-wise correction, and we have already corrected roughly around 8% from the record highs. And as you've rightly mentioned, that we are closer to the critical support zone, which is around 24,000. It's not on the psychological level, but on the technical parameters also we have multiple supports placed around 24,000 mark. So if this week is all about defending this zone. So 24,000, as long as we are holding up this mark, Nanda, we might see an attempt of some bounce or recovery. And earlier, the level which was acting as a support, 100 EMA, will act as a immediate resistance. So 24,500 to 24,000 zone is something that market might hover in, at least in the near future. And either side break is going to decide whether we are going to extend this recovery towards 24,750 mark, or we are inching towards the long-term average, that is the 200 days of exponential moving average, placed around 23,450. So 24,000 is a make or break area for the markets, and earlier it was IT, pharma, metals, they all were holding strong. Now we have only one sector which is showing resilience, that is IT. Banking also in the last trading session witnessed a very sharp pressure, slipping below 51,000 mark. Today we'll react to the ICICI numbers, so we need to see whether we manage to regain that level or not. So apart from IT, performance of banking is going to be very critical in defending 24,000 mark in the Nifty in this week.
All right, of course, as pointed out by Ajit, most of the sectors, in the throes of sell-off, except, of course, for the IT pack. But let's talk about the big one, ICICI Bank. Numbers were best in class amongst all the numbers that have come in thus far. HDFC Bank was also good, of course. Looking at a comparison between whether one should buy HDFC Bank because that's starting to perform, and ICICI Bank, good set of numbers, and today could provide that cushion that both the Nifty Bank and Nifty really need. But just to take you through the numbers, profit, NII, they've beaten expectations. Asset quality has improved, although net interest margin has seen some bit of a blip. Just want to quickly take you through what the brokerages are saying. CLSA has an outperform call, target price at 1,600 rupees or thereabouts. It's somewhere at 1285 or thereabouts at the current levels. CLSA has noted that it's yet another steady quarter for ICICI Bank, and both ICICI and HDFC Bank, in fact, stood out among their private banking peers in the second quarter. High standard asset provisioning among large cap banks rather for ICICI Bank, and even the loan to deposit ratio of 85% is fairly comfortable and lower than the peers. Only the fee income was a bit tepid, and that grew at somewhere around 13% on a YY basis. Nomura also has a buy call with a target price of 1575. Coming to the key question then, Ajit, which one would you prefer, ICICI Bank or HDFC Bank? Because HDFC Bank has been providing that support to Nifty Bank ever since it reported its numbers.
Yeah, that's true. In fact, last week also, despite the negativity that we saw on Friday, these top three names, Axis, SDFC, ICICI, they were not participating in that move. It was IndusInd Bank, which was altogether, trading in a different trajectory. These other private banking majors, they were holding strong, and I feel that both these names, SDFC and ICICI, they look good, from short to medium term time perspective. For HDFC, we are closer to the resistance mark, which is around 1800 levels. So it might take a breather around that area. For ICICI, if we, open gap up, let's say around 1300 zone, then it is okay to look for long positions with 1250 as a stop loss. Because we have not seen any major move in the ICICI yet in the last 1.5 months. And overall tone looks comparatively better if we compare it with the other private banking majors.
All right, that's about the private banking space. But what about Bank of Baroda? Good set of numbers. Profit has beaten expectations. Even asset quality wise, it has reported a good set of numbers. Bank of Baroda within the PSU banking lot, how is it looking now on the charts?
Yeah, so last week was a very tough week, especially for the PSUs, because we were seeing erratic swings, in line with what we were seeing in the other select private banking majors also. But the good part is that they are trying to, see this correction more of time-wise in comparison to price-wise. So for Bank of Baroda, 220.25 is the lower band and close to around 250 is the upper band. So we are closer or we are closer to the upper band of this range. So once we cross 250, definitely we get the comfort of this correction or this time-wise correction is over and we are set for the next leg of the up move. So as of now, it's an avoid. Once we break 250 mark decisively, definitely you can look to go long with 238 as a stop loss and 270 as a target area.
Company that reported numbers was Coal India. Weak set of numbers. Profit down 22%, revenue down 6 to 7%. Even margin shrank and came in at 28.1% vis-a-vis 30.6% or thereabouts on a YY basis. Looking at some of these PSU names, they've corrected from highs. How would you really approach the entire PSU basket now, particularly the power pack?
So yes, it's been almost like 3 months that we are seeing consistency in the overall corrective phase within the PSU basket, and Coal India has done comparatively better so far. But now the kind of indication that we have, it's similar to what we had in BHEL a month before, and after that we have seen a very sharp correction in BHEL, and now the Coal India is also testing its long-term averages. So any dip or a close below 450 mark may result in further pressure for this stock. So within the power basket now, still we are seeing mixed trend that some of these stocks, they are sitting on the sidelines, not doing much after the recent correction. But still I feel that it's prudent to avoid any PSUs, barring in certain defense stocks which are now seeing some sign of consolidation or accumulation. But the rest of the name, they are still struggling.
Coal India, of course, you're talking about Coal India because that stock is down 2.5%. Markets have really opened 9:15 a.m. It is some bit of green on the screen that I can see. The Nifty trading higher by 0.3% or thereabouts. But whether or not we manage to hold on to those gains as we progress during the day is the key question. Just taking a look at some of the other movers, and BPCL are doing well. SBI also among the top gainers on the index. The breadth, if you look at that, that's firmly in favor of gainers as of now. But let's see whether or not we manage to hold on to that or not. Aside of that, look at the mid-cap index gaining, with gains of, trading with gains of 0.2% or thereabouts. The Bank Nifty also 300-point uptick as we speak. It has managed to edge back above that 51,000 level. That's a relief. Just want to see what ICICI Bank, I beg your pardon, is doing at the current juncture. It's among the top Nifty gainers, 2.5% kind of an uptick in. Shriram Finance, that's the other one that reported numbers, and strong reaction coming to that, 5% up on a Shriram Finance. BPCL is the other one that's doing well. Remember, crude prices have come off quite significantly, $72. That's where the Brent crude is at. And of course, that's a boost for OMC stocks like BPCL, HPCL, IOC, all three doing well today. Metals doing well as a pocket. Hindalco, that's among the top Nifty gainers, and so is BEL, Bharat Electronics. Asian Paints, Bajaj Finserv, Bajaj Finance, SBI, NTPC. So financials also leading the way today. Look at some of the FMCG names. Britannia doing well. Even Sun Pharma doing well ahead of numbers. Titan, Hero MotoCorp, Nestle are some of the other gainers. On the flip side, Dr. Reddy's, that's under pressure. Reliance Industries also under some bit of pressure. Aside of that, if you look at Coal India, that's the top result reaction coming in, 3.5% downtick. ONGC, JSW Steel, L&T and Trent, these are some of the other losers. L&T, remember, reports numbers this week, and there was a brokerage downgrade that came in. Of course, there's some bit of corporate action in shares of Reliance Industries and Dr. Reddy's, which is why you can see, percentage fall is a bit diverse. Basically it's because of the corporate action. IndusInd Bank, SBI Life, Eicher Motors, these are some of the other laggards. Looking at the open, Ajit, Just about a green tick on the screen around that 24,250 mark. Uh, do you think this up move that we are witnessing at the current juncture has the legs to sustain, or do you think the complexion will once again change as we are 1 or 2 hours into trade?
As of now, Nandita, I was anticipating that after this, positive uptick, this gain should hold or increase, but that is not the case so far. So we are seeing some profit taking emerging again at the higher end. So as of now, it seems like a similar session that we used to see last week with a gap up start or a positive start, we eventually end around the day's low. So as of now, until we see some stability or some buying interest emerging in the private banking majors, then only this scenario may change. And once we cross 24,350 on an intraday basis in the index, so we are roughly around 100 points away from that mark. Once we reclaim that, then there is a possibility that we might inch toward 24,500.
Okay, that's the view then. But looking at the open, what would your top recommendations be for the day, Ajit?
Yeah, so I feel that it's still prudent to stay safe, considering that IT is the only sector which has left, untouched, or we are not seeing any major pressure now. TCS after this correction seems okay to us, considering that we have seen a decent, price-wise and time-wise correction in stock. The stock has already retraced to its long-term averages and now forming a base around 4,000 mark. So we anticipate a recovery towards 4,200, 4,250 mark. So with stop at 4,000, definitely you can look to accumulate TCS at current level. Apart from that, maintaining few shorts are also equally important. And the way Coal India has opened post numbers, the stock has slipped below its major averages also. Currently, we are hovering around that band. So indications of stock inching toward 420 seems high. So one can go to low short in Coal India with 462 as a stop loss and 425 as a target zone.
Okay, that's the view on in fact, those are the top recommendations coming in from Ajit. But Ajit, I want to get in your sense on Shriram Finance. Top Nifty gainer numbers are pretty steady, but I think the stock has seen some bit of volatility, over the last few weeks. Would you look at this, within the NBFC space? Is it looking nice? Because today, of course, we saw a 5% uptick, but tempered off a bit, 3% up now. But in the last 1 month, the stock has shed 10%. Do you think it is in the oversold territory now, and perhaps it's time to start nibbling in?
Yeah, so in fact, Nandita, it's among the top performing names because though we have seen decent correction from the record highs, but the way it has corrected, it's very gradual. So that indicates that the weekends were exiting this stock, in line with what we are seeing in the market correction. And after retesting its 100 EMA, now we are seeing this recovery, strong recovery. So we expect, yes, within the finance space, definitely one can look to go long or accumulate this stock as long as we are holding off 3,000 mark. So one should accumulate. One should not just go ahead and buy aggressively at current levels. So accumulating this range of 3150 to 3250 and maintain a stop loss at 3000 and hold this stock for the next leg of the up move, which can help this stock to inch towards the new high. So 3550, 3600 is going to be the next target zone.
Okay, accumulate is the call and not to go all in at the current juncture. That's the view on Shriram Finance. But I want to also get in your thoughts on a credit access. This stock is down 5%. This stock has been in a sustained downtrend, right? Today we have, of course, there's asset quality pressure, reported numbers. Today we have a brokerage downgrade coming in. CLSA has downgraded the stock to hold. Target price has been cut to 918 from 1800. So it's already been halved from where it's at, in fact, from the kind of target it had earlier. There were issues in the second quarter performance, net profit halved, elevated credit cost. Management has also trimmed its loan growth guidance, and credit cost guidance has been revised upwards. So lots of issues with this particular stock, right? And we've seen it play out on the stock price as well. On a YTD basis, the stock is down 40%. In the last 1 month itself, it has shaved off 22%. 929 is where it's at, very close to where the target price has been placed by CLSA, 910 or so. Is it time to exit this counter? Even if somebody has positions, would you advise them to book their losses?
So not now, Nandita, because you mentioned that it's almost half from the its record highs, and now we are very closer. It's anyways looks extremely oversold, and now we are trading very closer to the monthly support area, which is placed around 850, 860 zone. So if you are holding it, let's say from higher levels, 1050 or maybe higher, you can continue to hold this and see whether it manages to hold this level of 850 on the closing basis or not. Because due to the oversold position, we may see some respite in the stock, which can help the index to inch to stock to inch toward 1050, 1100 mark before any further decline. So for the traders, it's an exit opportunity if we see any bounce. But yes, exiting at current levels is something that might regret, considering that look extremely oversold, and we are very closer to the monthly support area as well.
Okay, that's the view on credit access. But let's shift focus to all the stock related queries that are trickling in this morning on our feed. Then I want to take up a query on Poonawalla FinCorp. This one's coming in from Srivardhan Gupta. He wants to know if the crash that we have seen in the stock price a good opportunity to take positions for the medium term, or should one wait for further downside? 25% shaved off in the last 5 days. Would you wait for further declines, or would you look at buying this now?
So Nandita, with this decline, the stock has slipped below its the major support. In fact, it was trading below the major supports earlier also when it comes to the daily time frame, and now we are slipping below the weekly and monthly time frame as well. So that might push the stock further lower, and maybe close to around 250 to 225 zone is something that it might take up either next. So not at current levels, but yes, around let's say 10%, 15% of more decline. It may take some time, means due to the oversold position, it might see some bounce, but buying at current level aggressively is something that one should avoid. One can start nimbling, let's say with the lighter hands, and maintain at least till 225, 250 as a buying zone. And then one can hold for some recovery towards 300, 325 levels.
Okay, that's the view on Poonawalla FinCorp. Hope that answers your query. The next query is coming in from Puneet Rajiv. He wants to know your thoughts on EMS Limited. He has some holdings. He has shares at the rate of 850, and the stock has come down to 750 or so. The stock has seen a good run in the last 6 months, but last 3 month returns have been negative, and last 1 month also it hasn't really done much. Pretty sideways, but he's making a loss here. How would you advise him to navigate this position?
Yeah, so in fact, it's almost 3 months now that we have been seeing this stock witnessing consolidation after making a high around 900 plus zone. It made an attempt of recovery and surpassed that previous swing high, but it couldn't sustain. So now we are again seeing a bit of consolidation, and we are trading closer to the lower band of this range. So I would suggest him to maintain 725 as a strict stop loss for this trading position. And once we break 780, then definitely he can trail the stop loss to 750 plus and wait for 900 being the positional target. So as of now, we are very closer to the support area. So maintain longs with 725 as a strict stop.
Okay, that's the view on EMS. Hope that helps you. The next query is coming in on Tata Steel. Metal stocks have been fairly volatile. They tend to react to global news flow as well. But Tata Steel in particular, we've seen bouts of up moves on, this stock as well. But looking at the consolidated 1 month return, down or giving negative returns, double digit negative returns, even 5 sessions, 5% kind of a cut. How are you viewing the entire metal pack now? And within that, where do you see Tata Steel heading? Because it's somewhere around 147 at the current juncture. Any levels that you'll be watching out for on the upside for this stock?
Yeah, Nanda, in fact, the metal pack, like I have said earlier, that with the beginning of the this correction, IT, metals, and pharma, they were holding strong, but eventually now we have only IT left, while the others are also struggling. Uh, Tata Steel, in comparison to the other metal counters, it didn't participate much, or maybe the kind of quantum that we were anticipating it earlier, it couldn't match to that level. And during the correction, also we are seeing comparatively, underperformance in comparison to the other metal names. So as of now, I would recommend to avoid any fresh position. But yes, since we are again closer to the support when it comes to the metal index have already tested its long-term averages. So that might result in some bounce. So one should not exit the position right away. The last trading sessions low close to around 144 is something that one should maintain as a stop loss, and use any recovery towards 154, 55 zone to exit your longs. So it's likely to underperform, even in the coming weeks also. So prudent approach is to stick with the top performing names like National Aluminium, Jindal Steel, VDL. They are comparatively better.
Okay, that's the view on Tata Steel and the entire metal pack. Some of the names that look much better on the charts that Ajit mentioned, please take note of them. But otherwise, let's take up a query on the paint sector as well. Alex wants just to know your thoughts on Berger Paints. Is it a good time to accumulate or wait? Same for paint stocks, right? When you see crude coming off quite a bit, we see a sudden spurt in some of these paint stocks. But if you look at the returns per se, they have been fairly negative. Paint stocks haven't really been able to establish a trend, so to say. Uh, Between Berger and Asian, anything that's catching your attention that is worth a buy now?
Yeah, so Berger Paint, Nanta, we've seen decent correction in the last 5 6 weeks. Again, the stock has reached closer to its major support area, which is placed around 520-25 zone. So the risk to reward was definitely favorable. And as a disclosure and disclaimer, we have recommended Berger Paint as a investment recommendation also in our Diwali pick portfolios. So both for short to long term, definitely it looks positive to us. 520, if you are a trader, should be a stop loss. And in the next swing, maybe close to around 575, 580 is something that one can wait for.
Okay, that's the view on Berger Paints. Hope that answers your query. But more queries coming in from the banking space. Lots of earnings to digest, I think, which is why a lot of queries coming in on the banking pack. This one's coming in on an IDFC First Bank, clearly under pressure, 5% lower. There's been asset quality concerns. Numbers have been weak. Shares are 30 rupees away from 52-week high. 62 is where it's at the current juncture. Very close to 52-week lows. In fact, it hit 52-week low at open as well. Would you advise for the long term? Do you think these levels are ripe for entry?
Yeah, so Nanta, it's been almost fifth or sixth quarter that we are seeing the stock, drifting gradually lower, and the level from where we've started this, rally in the stock, close to around 55, 60, something that we have already reached. So I feel the downside seems capped in the current levels, considering the overall correction and the tone that we have in the stock. So yes, one can start accumulating, and I feel that 55 is something that one should maintain as a stop loss, considering that's a very strong and major support for the stock. In case if it fails to hold that, then this trend might reverse completely altogether, the long-term trend also, and the stock might undergo into a prolonged corrective or consolidation phase.
Okay, that's the view on IDFC First. Viru Paksi had written in on this one. Hope that answers your query. But just about time for one last query then. Sudhir Poddar wants to know your thoughts on IRFC. How would you really look at the railway and defense pack now? You think the story has run its course? And is it a good time to rotate out of these?
So Nanda, it's too late to think about exiting those names, because they have already corrected 50%, almost 40 to 50% from the record highs. At the same time, defense stocks are selectively seeing some buying interest emerging at the lower end, but the railway stocks are not finding any buyer as of now. So short term, yes, this kind of corrective tone might continue, but we are closer to the immediate supports here in railways counter also, and IRFC, this zone close to around 125, 28 is something that it might respect during this corrective phase and may see some recovery towards 150 level, 55 levels before any further decline. So again, I would suggest that utilize any recovery to reduce your position, and yes, comparatively better structures and charts that we have placed. So for fresh buying, definitely one should avoid railways and the other PSUs.
Okay, that's a view on railway stocks. But with that, we've come to the end of the query segment, and Ajit would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. Always a pleasure chatting, and I wish you a very, very happy Diwali.
Yeah, thank you, Nandita, and I wish you, your team, and all the viewers a very happy Diwali, and we'll catch up soon. Thank you.
Thank you. Thanks a lot. Well, on that note, let's quickly take a look at what the markets are doing before we get our fundamental guest on board to talk about the setup really. Mid-cap index has given up opening gains, shade in the red right now. Markets also off their opening highs, although the Nifty is clutching on to that 24,200 mark. But the Nifty Bank index is exhibiting strength, and thanks to ICICI Bank, because that's also keeping the index afloat as of now. 2.5% gains on ICICI Bank, and even Shriram Finance. That stock is up somewhere around 5% or thereabouts, providing some kind of support to the market. But on that note, let me bring on board our next guest for today. Joining me is Anand Rathi, who's the founder at MIRA Money. Anand, great to have you on the show. Texture has changed. I mean, we've corrected almost 8% from highs. Would you see more correction, or do you think much of the correction is out of the way and valuations are looking a little fair now?
Thank you, Nandita. Yes, the valuations are looking slightly better. It was, of course, way too high, and these are all post-mortem that we can always do. Can you hear me?
So, what according to you? Yeah, please go on.
Sorry, I was saying the valuations were a little high, and these are all post-mortem that we can always do. Valuation for sure on Nifty is a lot lower, and it is very close to its fair value right now. And we strongly believe that there can be some bit of a correction going forward, but it is not going to be as significant as what we have seen in the last 2-3 weeks or so.
Okay, so where do you really expect the market to end the year? I mean, I know you don't talk levels really, but would you say that we could actually retest those 25,000, 25,500 mark, or would you say that here on expectations have to be tempered, given the fact that earnings haven't been all that enthusing?
Absolutely. So you answered it there, Nandita. The earnings have been not as per expectation. It was expected to be poor, but this was way too poorer than what a lot of analysts ourselves figured out. So I don't think the kind of bullishness with which I had come in last time around is still there. But I don't see a reason why. We just need to assess whether this is a cyclical downturn or a structural downturn. I hope it is cyclical. So the next quarter results are going to make a lot of importance. So what we are going to track is how are the GST numbers coming in post Diwali, what is the kind of way-bill numbers that are going to come in, and then take a call. But for sure, the numbers have to be tempered in. It is not going to be as high as, let's say, it may take some time to touch the all-time high that we saw this month.
A lot of sector rotation is also underway, but barring the IT sector, most of the sectors have seen a drubbing, right? Even the Nifty Bank index has been holding up. It was perhaps on Friday that we saw, a drawdown thanks to 20% slump on shares of IndusInd Bank. But, which are the sectors, looking at the earnings that have come in so far, which are the sectors now that, warrant, a buying on dips kind of a scenario? Would you say that banks is one pocket where one could park money, and IT, where does it stand? Because we have seen a good rally coming in IT stocks. Valuations wise, do you think they are ahead right now and perhaps a bit expensive?
Very true. IT, last time around, we were mentioning that it is looking strong to us. There is good revenue growth that was expected at the cost of profits. And that has turned out to be pretty true. At this valuation, is it the best sector to be in? I may not think so, but yes, it still warrants some bit of an allocation. That is IT. Now, talking about banks, quality banks are now showing their true colors. They are coming out and giving great numbers. We saw HDFC, we saw ICICI doing very well, and I think now is the time that has come for Bank Nifty and especially these two, three large banks to show the true colors, which is well managed banks, right? So we believe banking time has come, but may not be for the index overall. Maybe you need to look at stock specific investing in banks.
You know, a lot of experts say that this is a correction that has separated the men from the boys. You know, which are the pockets, according to you, are the men in this correction? Which ones would you really pinpoint, saying that, you know, this is what I or you must look at right now? You know, if you are looking at cleaning your portfolios, you know, perhaps this would present a good opportunity, right? Because we have corrected, and you know, there are certain pockets that may have maybe offering valuation comfort. So where would you look for that?
So, in my view, if you actually see, there are a lot of these good, well-managed quality companies that are doing very well, right? You go to, you see how ICICI, HDFC, and few other FMCG names, and going forward, like ITC and all that stuff, have come out and given good numbers. These are the true men. So, what is really taken over at the moment is quality. Before this, there was a lot of momentum-oriented investing that was doing well. You touch anything which has got momentum, they ended up doing well. PSUs, for example, are the real boys that are now out, which is great news because that would mean the real good capital will start chasing quality companies, and that's what we should focus on. And especially during markets like these, where you can fall 4-5%, these quality names will stay put, while the momentum names will come down significantly, as you have seen in the last few weeks, right? So my view is stick to good quality large cap companies. Mid cap is still a little overvalued. Small cap, I think a few good companies are showing positive signs, but we may have to wait out and watch out on small cap space. But for sure, good quality large cap companies are our picks.
Sure, good quality large cap names. But you know, looking at the FMCG numbers and numbers coming in from the consumption universe, the story that has emerged thus far is that there has been certain amount of slowdown in urban spending as well, right? Although rural has seen some bit of an uptick, but that's a story that will play out gradually. But in terms of urban consumption slowdown, on one hand, you've seen retail names citing slowdown in urban demand, but on the other hand, you have fair bit of demand for all these concerts that are taking place, and even in terms of quick commerce, a number of orders are seeing an uptick. So within the FMCG and consumption space, what is it that stood out for you from the quarterly numbers, and based on that, which are the plays that you would look at?
So I was actually honestly surprised with the kind of numbers that urban consumption, the percentage growth that a lot of these FMCG companies came and showed. I actually thought inflation may not really affect them and they would affect rural, economy more, but this turned out to be the reverse. Rural is recovering while urban is struggling. I still think that premiumization of a lot of urban consumption is going to happen. So if you are a player who believes that I should invest in urban consumption story, then look at someone buying an X company today for let's say X stock today or an X shirt today for 100 rupees, but then he's ready to buy the next one for about 200-300 rupees or so. So the real theme, if you want to play the urban, is premiumization while you play the rural economy the FMCG way.
Okay, that's the view then. But last question really, in terms of funds, what are the kind of funds that, investors should tilt towards, thematic funds? We've seen quite a lot of interest in thematic funds over the last year or so, right? Here on, would you look at, multi-cap funds, large cap funds? What kind of funds should one have in their portfolio to maximize returns?
What we would like to do is keep about 80% of the money in large cap funds, pure large cap funds, and maybe index funds as well. And the remaining 20%, maybe a little bit of a flexi cap fund. But if you know the markets well, if you can take the volatility in the stride, then you should look at few sector funds in your portfolio. If you actually, disclaimer is if you know how to play the sector funds. So for example, you can look at IT sector, you can look at pharma as an option in your portfolio, and this is for about 10% of your overall portfolio, while you focus a lot more on large cap funds only.
All right, that's the view. Stick to large caps. That's the theme going forward. But with that, Anand, would like to thank you for taking out time and joining in and sharing your thoughts with us. Always a pleasure, and I look forward to interacting with you again in the near future. Thanks a lot.
Thank you. Bye bye. Take care.
Bye. Just want to point out for the market then, we have slipped into the red. The Nifty, in fact, below that 24,150 mark as we speak. Mid-cap index also trading in the red. But the Nifty Bank index is holding up smartly, 51,100. It's above that level. It's a 350 point uptick there. Talking about the movers then, some corporate action in Dr. Reddy's, which is why you're seeing such diverse stock performance. Reliance Industries trades ex-bonus today, which is why it's showing a 50% cut. Apollo Hospital is the top Nifty loser. Trent, Bajaj Auto, Ultratech Cement, Hero Moto, L&T, these are some of the laggards. And Shriram Finance, on the other hand, holding up smartly, good set of numbers, steady set of numbers, 5% up. ICICI Bank, best-in-class numbers within the private banking space. Stock is up 2.5%. SBI also providing support, 1.5% up as we speak. So all in all, we have given up gains. That's the trend that has been playing out over the last few sessions, and it continues. But let's see whether or not we manage to see some bit of green tick again as we progress through the day. Another important listing to watch out for at 10 a.m. is Waaree Energy is expected to make a strong debut. Keep an eye out for that. But for now, then, we are done with the show. Thanks a lot for tuning in. Stay tuned to Money Control for all your news and updates. And of course, we'll see you back at 3:30 p.m. on closing bell with how the markets managed to shut shop and what are the stocks that will be on our radar this afternoon. Thanks a lot for tuning in. बीच में बंद हो गया मैं